So how do they sit in a volatile market? I love this graph here, big kind of cliff here. This is the coronavirus pandemic when, things really got tough, the world started to shut down and lock down. There's actually not a crazy amount of volatility between the funds. Hey everyone, my name's Glen James. I'm going to be taking you through some examples of the Vanguard Diversified funds, the ETFs that they've got on offer. We're going to have a look under the hood, behind the curtain of one of them, and hopefully by the end of this video, you'll be able to work out whether the Vanguard Diversified investment option is for you. And just a general disclaimer, this is general advice only. I'm not taking into account any of your needs, personal situation, goals, any of that stuff, information only, and I do not have a commercial relationship with Vanguard, although if they want to give me money, I'll take it. So if you are interested in learning more about investing and really getting deep and understanding the concepts in more detail, and you like reading, you can order my book. There'll be a link below. And we spend, there's probably around 40 to 50% of the book that is talking about investment concepts. There's a heap of case studies in there. We talk about ethical investment options, and it really is the next level up that you might need in your investing life. But also, if you're not ready to invest, the book does offer some help setting up your sound financial house, budgeting, cash flow, mindset, money. We talk about property, superannuation, all the good stuff. So if you want to support what we're doing here at My Millennial Money, please, by all means, grab a book and grab one for a friend. I want to cover modern portfolio theory and the background behind diversified funds and how portfolios work together. I want to look at investment time horizons. So I'll show you the type of funds that Vanguard offer and where they might be suited to you. Where else? Behind the curtains of one of the funds. So I'll unpack behind one of the funds, and the concepts that I talk about with that fund can apply to all of the funds. We'll obviously talk about the benefits and limitations of the fund, the fees, that's a big one everyone always gets excited about, and the returns. We're not investing to not get anything above the cash return. We want to put our money at risk, and we want to actually invest and make some money. So modern portfolio theory. You probably have not heard of this guy. He's named Harry Markowitz, and he basically is an economist from the USA, and he put together this theory that your portfolio shouldn't be siloed. And what I mean by that is, if this is your portfolio, and we'll just put, growth or risk, and we might put time along the bottom here. If in your portfolio you had, and I'll use yellow, CBA shares. So for example, over time, CBA shares might be doing that. I'll do green. Woolworths, you might have Woolworths shares. It might be doing this over time. You might have some fixed interest funds, which we'll get to, that might be doing this over time. So what modern portfolio theory basically means is, we can't look at our portfolio and say, well, this share here did 18%, this share here did 15%, and this fund here did 2%, or whatever the returns are. Modern portfolio theory basically means we're putting all of the parts into the portfolio, and it's giving us an average return of 8%. So we're not siloing our returns. And I believe Harry, the economist, started this with individual shares, but they work with managed funds and all types of investments. So another example, if you had $20,000 in your cash account ready to place a trade, and you already had $5,000 in shares, CBA shares, your portfolio total is $25,000, except $20,000 of that is in cash. So I think it's just important to understand the premise of modern portfolio theory and why diversified funds came about. So let's have a look at the Vanguard Diversified ETFs that are available. The first one is the Diversified Conservative Index Fund. And what I might do is, I'll draw it in purple. So this fund here has a 30% allocation to growth assets. So the remaining 70% in the portfolio are defensive assets, cash, fixed interest. The Diversified Balanced Index Fund, it has a split of 50-50. So it actually balances. 50% of the money is growth, 50% is conservative. The Diversified Growth Index Fund, that has an allocation of 70% growth assets and 30% conservative assets. And the last portfolio in the suite is the Vanguard Diversified High Growth Index Fund. And basically how that works is 10% of that portfolio is in defensive assets and 90% are in growth assets. So let's have a look at how they might work on a investment timeframe, a risk profile, and when it might be suitable to use each of these funds. We might go with this axis being value or the market fluctuations, and this axis being time again. So we'll use the example of you've invested in something and it's over time, the markets are doing this. We know that if this here was 2 years and there have been market fluctuations and you needed to take that money out, there is a chance that it could be worth less than what you paid for it. Whereas if this was the Vanguard Diversified Growth Fund, which has a 70% allocation to growth, that's going to do its thing. And it's likely that if we need to invest for less than 5 years, well, we'll take that risk because the exposure to growth assets are going to have more volatility than the Vanguard Diversified Balanced Fund, which has a 50-50 growth. So I guess what I'm saying is the higher the growth in the portfolio, the more time that is needed in the market. I would generally say any growth assets that you have, you really want to commit that to the market for at least 5 to 6 years. If, for example, we had Vanguard Diversified High Growth Fund, over, say, 7 years, I'm being dramatic here, but it could look like that. Now, and I will show you some practical examples, but if we want to invest over 7 years, well, that's fine because we can handle this volatility. So the question is, when you're investing, the first thing you need to look at is your goals and your time horizons. It might be okay, well, I've got 5 years to invest. I know that there's going to be too much volatility with a 90% growth. I know that, 70% still might be a bit too much volatility. Well, 5 years, I might take some risk and use a 50-50 split. Again, remember the modern portfolio theory, and I'll illustrate this in yellow. We might be able to use the 50-50 split so we get a smoother return over that 5 years. Obviously, this is not to scale. So let's have a look behind the curtain of the Diversified Growth Fund. So if you put, and we'll call it $10,000. If you invested $10,000 in the Diversified Growth Index Fund, we know that 30% of this fund, and again, not to scale, is in defensive assets. 70% is in growth. So if you put $10,000 or $1,000 into this ETF, what's happening behind the scenes? Vanguard are taking that money and splitting it up across a whole heap of different asset classes and a whole heap of different ETFs under the hood. 27% or $2,790 is going to be invested in the Vanguard Australian Share Fund, because within, like if I redraw that here, let's redraw it, we'll just say 20% there is going to be an allocation of 32% to VGS and VGAD. And I won't get into the weeds with this at the moment, but with international shares, Vanguard will take your money, invest 20% into VGS, and then they'll put 12% into the hedged version. Now, I'll try and explain this really simply. When Vanguard take your money and invest overseas, they're buying a whole heap of different currencies. So to get access to the stock exchanges in Europe, well, they've got to rock up with European money, might be the pound, might be euro. They want to go up to America, they've got to rock up with USD. Now, what the hedged version does, it has some options contracts that hedges against any currency movement. So Vanguard have taken the view that of the 32.5% allocation to international equities, we just want to hedge 12% to smooth out any currency movement if there is volatility. Now, a lot of people might say, well, part of the investing overseas is the exposure to different currencies, so I'm happy to also take that risk. There's 4 and 5% in some emerging markets and some small companies. And within those funds, so VISM, 65% of that fund is in North America anyway. And you can literally just Google VISM, go to the Vanguard website and look actually what they're doing with these funds. And the top 10 holdings of both these funds, you probably haven't even really heard of the companies. I think Vanguard Emerging Shares Index Fund, maybe one of the top 10 holdings you've heard of is the Alibaba Group, which is, the eBay of China. The remaining portion, or the defensive part of 30%, is split up against Australian fixed interest and some global bonds. And that's pretty much what you get. When you put $10,000 in, you get diversification across asset classes and the skew to the risk profile. So for example, if you invested in the Vanguard 50/50, where this is 30/70, they will be taking some of this heat out of the international and Australian share kitchen and plugging it back into defensive assets. So just to smooth out that portfolio. So how do they sit in a volatile market? I love this graph here, and let's have a look. So this big kind of cliff here, this is the coronavirus pandemic, when things really got tough, the world started to shut down and lock down. But I think it's really interesting that going back to that chart with risk profiling where the funds fit in ordinary times, there's actually not a crazy amount of volatility between the funds. But if we have a look at the grey line, that's the high growth fund, which remember has 90% allocation to international and Australian shares. And the orange one here, that's got 50/50. And this one here has got 70% allocation to growth, which is that rosy kind of colour. So we know there is more volatility with the higher the risk. Okay, you can see that volatility. So markets got choppy, the world fell apart, heaps of action in equity markets. But as time goes on and things recover, we start to normalize. And if you have a look here, this is a fascinating graph. All roads are leading up here to Rome, but there's just that difference in the allocation to growth assets. So anyway, I just think that's a really fascinating chart to look at. And, the higher growth assets you have, the more volatility you're going to have. So you've got more upside here, but there's more downside. And people say, well, I don't invest in shares because you lose all your money. You would have only lost, quote unquote, all your money at the coronavirus pandemic if you sold at the worst time possible. So if, for example, in the start of 2019 through to April 2019, that's a very short term. Sure, you may have got lucky investing in VDHG, for the first few months, oh, sweet, I'm doing so well. I'm just going to withdraw my money now and buy a car. Awesome, you've struck it lucky. But if you held on an extra week, that portfolio has fallen through the floor, and you may have halved your portfolio if you did take that money out. So it's horses for courses, and this is why the pre-mixed portfolios really set up the allocation to growth and defensive, and you can work out what allocation you want in your portfolio. So let's have a look again at the modern portfolio theory in practice. These are 4 of the funds that are actually in the Vanguard Diversified High Growth Fund. So I've just gone and kept the extra aggressive fund in this one, which is 90% growth. And you can see that's there. But these other funds here, and we know they've got a very small allocation in the portfolio, they're quite volatile. You can really see there that these international small caps and to a point, the emerging markets funds, the highs are going to be higher and the lows are going to be lower than a blended portfolio. And just as a kicker, I've put a boring index fund in there, which is the fixed interest index fund. So you can really see the modern portfolio theory in action, how we've got this fund here, we've got the 2 aggressive ones, which, I think there's 9% allocation between the 2 of them in the portfolio. And if I just draw this through here, we just get a smoother return than trying to pick all these different winners, okay? So let's have a look at the returns. I've done this until April 21 because this is the actual one that I used in my book as an example. And I've used the managed fund versions because the underlying funds are basically the same in the managed fund and the ETF. And I want to just use some long-term data of the fund because the ETF versions weren't around for 10 years. So, and again, we don't want to invest in growth assets for really less than 5 to 6 years. If we did invest in the high growth one, which is the 90%, over the last 10 years, yeah, sure, we've done a 10% return. Awesome. But remember, you've got a lot of volatility along the way, and you need to understand that the volatility is there because there's a higher allocation to growth, but longer term, we have got a higher return. We have a look here at the Diversified Growth Fund, which has a 30 to defensive 70% growth, which probably might be around your 5+ years, and this one might be around your 6+. Again, you can have a look at the fact sheets on the Vanguard website. Really easy to understand, everyday language. And certainly the 50-50 here, I probably still wouldn't be looking at that at under 5 years because it's still invested in the market. And we have a look here, over the last 10 years, 7.92 is a good return. But if we did happen to hold it for 5 years, well, there is still some meaty returns. But the question is, to get this extra, 1%-ish return, can you stomach the volatility? And it's all about understanding your risk profile and what you can stomach. Because if we go back here to this diagram, you can see the extra 1% that the portfolio does. And diversified portfolios, there's a lot of data and science that go into these portfolios. And generally speaking, a company with a long track record and a decent portfolio, it will do what's on the box. But the problem is we get involved as humans. Coronavirus happens, we freak out and we sell it here, and we lose all our money and we freak out and we don't like investing. But if we understand the higher allocation to growth, the more volatility in the portfolio, which means we need a longer time frame to hold the investment. Let's have a look at the fees. So if we've got $5,000 invested, the 3 Vanguard funds, the balanced growth, the growth, and the high growth fund, 0.27%. Really cheap. If you've got 5,000 invested, it's only costing you $13 a year for Vanguard to manage that fund for you. That's pretty cheap. I like to think it's cheap anyway. Now, if you went, just for comparison, if you said, well, I just want to invest in the Australian Shares Fund, it's only 0.1 or $5 a year. So we know Vanguard, an index fund manager, it's low cost, low fee, invest, tracks its index, keep your mitts off it, it'll do its thing if you let it do its thing. The International Share Fund, international shares, bit of extra money to manage with some currency there, I'd imagine. So 0.18 or $9 per $5,000, really cheap. Now, why not DIY? You can actually say, I want to use the Vanguard Diversified Growth Fund and set it up myself. So there's 30% defensive, 70% growth, and I'm just going to buy 1, 2, 3, 4, 5, 6, 7 ETFs myself and manage it myself. Now, I worked out that with the fees of the individual ETFs here, to build your own fund here is 0.19% per year, whereas if you go to Vanguard and say, I want my portfolio in a box, it's 0.27% per year. So basically what we're saying is, for $19, if you had $10,000 to invest, and a lot of you don't have $10,000 yet, that's fine. I just like to use a little bit of meat to discuss this. If you did have $10,000 invested, building your own portfolio, $19 a year for $10,000, bloody cheap, shut up, oh my gosh. But if you use Vanguard's portfolio in a box of 0.27, that's only $27 a year for them to manage it for you. So it's an extra $8 for them to do it for you. Now, for me, I'm not even entertaining the idea, because what Vanguard do, presumably every quarter, if this allocation here, if there's been a run on the Australian market and that increases and it puts some of these allocations out because of this growth, they'll rebalance that. If you want to rebalance it yourself, each time you place a trade to buy or to sell an ETF, you might have a $5, $10, $20 fee to place that trade, not to mention the time factor and having to pay attention. So I think it's pretty compelling to have a Vanguard solution, a DIY portfolio in a box. So coming up, we'll talk about the benefits of the Vanguard portfolio. We'll talk about the limitations that I see to these portfolios, where to buy them from, and where they sit against other ways to invest. I just want to jump in here and say, if you're liking these videos and you want to really get deep down and have a look at some beginner basics to investing and just concepts about share platforms, risk profiles, asset classes, indexes, active versus passive, all that stuff, the Glen James Investing School, you can do that. It's only $88. There's a link below, and I'd really value your support, and thank you for watching this video. All right, so the benefits that I can see of the Vanguard Diversified Funds is, relatively low cost. I mean, shut up. Why are we talking about this? 2, it's a portfolio in a box, turnkey solution, invest, set, go, see you later. The asset allocation is sorted. So we know that they've got a target asset allocation that is sorted to their target asset allocation. And Vanguard might say, look, within this portfolio, the Australian equity allocation, it will be between 25 to 35%, and we'll just adjust every quarter to get it in line with the benchmark. So they sort the asset allocation, and in that fee of an extra $8 for, as I discussed earlier, they'll take care of the rebalancing. Now, it's easy for you to learn how to understand markets and how the fluctuations in markets work. So if you've got a Vanguard Diversified Growth portfolio or a Vanguard Diversified High Growth Fund, and then you're watching the news one night and you see that the person on the news is like, oh, the American market tanked overnight and the Australian market tanked. You log in the next day, or a couple of days later, if you've got a managed fund or whatever the investment vehicle is, and you'll be able to see that reflected, because we know equity markets are priced daily. And as I said before, it's available as a managed fund, and Vanguard have a very long track record as a fund manager. It's not their first rodeo. They've done this for years. Their portfolios generally do what's on the box. What are some of the limitations of the diversified funds that I can see? So you might want a portfolio without any bonds. Well, we know all of their diversified funds have a defensive portion because they use that to smooth out the returns in the portfolio. And we know over time that generally speaking, a portfolio with a slight allocation to bonds or defensive assets will usually do better than 100% equities, because with compounding negative returns, you will effectively have the same thing as compounding positive returns, which means that if investment markets tank and you've got a high allocation to growth assets, the negative returns can compound, which means the losses are greater, as you saw in that diagram. The depths are lower, the heights are higher with a high growth portfolio, but with the allocation to defensive assets, it just smooths out the portfolio. So there are bonds in the portfolio. That's what I'm saying. You might not like a portfolio that has a hedged international equity component. So if that's you and you're a bit more advanced and you want to just go straight in, this portfolio might not be for you. So the Vanguard international funds track the MSCI World Index, and a lot of people are like, well, I want VTS, which is a Vanguard ETF that just does the US market. So if you do want really heavy exposure to the S&P 500, this portfolio might not be for you. But I think, and you can check on the Vanguard website, I think there's their international equity portfolio, I think 65% is North America anyway. It could be too expensive for you. If you think, $27 of $10,000 invested is too expensive for you, you might want to do it yourself and build it yourself for $19 per $10,000, knock yourself out. And the risks actually, if we go back to the advantages, the automatic rebalancing included in the portfolio is really advantageous, because what happens is, as the portfolio grows, and if growth portions get out of whack, they'll sell down the growth and commit that to the defensive portion and reshuffle. So you kind of lock in some growth into your portfolio. And that's why over time, a portfolio with an allocation to defensive assets might actually do better than a 100% growth portfolio. So you might think, it's too expensive, I'm not doing it. I won't go deep on this, but if you're about to retire and you've got a superannuation pension, you might need something a little bit more bespoke for your drawdown requirements, and you might need to split the portfolio up and not actually have a one-stop shop. And it follows an index, so there's no real ethical screening. So if ethical investing is for you, this might not be your portfolio. And if you straight up want an active fund manager, buying and selling and try and beat the index, well, obviously this portfolio is not for you. So where can you invest in Vanguard? The Vanguard Personal Investor Platform, that's Vanguard's own platform. And I did another video that you might want to watch. We'll put a link in the show notes, and if I can get a link on the screen here, I'll put it up. And that's another deep dive just into the platform. If you've got your own share broker account, so you might have a SelfWealth account, CommSec account, Open Trader account, whatever you want to use, you can just go and buy the ETF. You might have an investment bond or want your investment bond. So, full disclosure, I have a Gen Life investment bond that I use, and I use the Vanguard Diversified High Growth Fund. It's just a set and forget portfolio. And that's like my second little superannuation that I use. Wrap platforms, so your Hub24, your Net Wealth, your Macquarie Wrap, BT Panorama, all the wrap platforms. If you're a wholesale investor and got over 500 grand, you could knock on Vanguard's door and say, give me some of that action. Or, your financial advisor may recommend it. A lot of the My Millennial Money podcast listeners have an advisor, and they've recommended Vanguard portfolios. So where do they fit in the broad scheme of things? So we know cost is a thing, and ease of management. is a thing. So if you just want to build a portfolio of direct shares, I just want to buy CBA, Woolworths, ANZ, I'll get some exposure to Apple in the US and just build my own share portfolio, we know that's bloody cheap because it's the brokerage cost only, and then you don't have to pay a management fee. That's cheap, but you'll get all the paperwork yourself, you got to do all the work yourself. The next one up is your own portfolio of ETFs. So you've decided, I might want to buy Vanguard Australian Share Fund. I might want to buy a Beta Shares Fund that's got some sexy things happening in Asia. I might want to buy IVV, a BlackRock fund, or whatever that is, and build your own. We know that that might be more expensive because each ETF has management fees, and the Vanguard Personal Investor Platform video goes into detail around management fees and obviously your brokerage as well. And then you step up a little bit further, and then we've got our DIY portfolio in a box that we've talked about. So, 0.27 as a fee. If I built that portfolio, 0.19, and as a direct share, there's no management fee. All three have brokerage, so you might have to pay $5 to buy, or $19 with some brokers, or $10 for some brokers. There might be some brokers that do promotion and it's no cost as brokerage. So that's where it fits in the world. And again, everything in life, there's trade-offs. Usually you get what you pay for. Hopefully you get what you pay for. If you want to pay $8 more for $10,000 invested, and to have Vanguard do it all, invest it, you move on and you just pump that, that's the solution for you. If you want to do it yourself, it's cheaper, more paperwork to track, but that's on you. So what do you think? Let me know in the comments what you think of this video, what you think about the Vanguard Diversified funds, if you use them yourself. I like looking at all the comments. And if you want me to cover any other videos or do any other comparisons or looking behind the curtains of any different funds, let me know. I'm loving doing these videos. I think for me personally, we've really found the sweet spot of how I can execute the YouTube strategy for My Millennial Money here on My Millennial, or here on M3 TV. And I really appreciate you watching. If you're still watching, I would value a like and possibly share it with a friend. I mean, I just want to add value, and there's no cost for this video. And if you want to support us by listening to a podcast or buying my book or doing the online course, I'd really appreciate that. Thanks so much for listening. I'll see you soon.